Hey guys, Calvin here. One of the first questions when an investor is opening a new brokerage account is which stock markets to invest in. Since I live in Singapore, the Singapore Exchange or SGX will be the natural and default choice. However, it might be a good idea to gain exposure to at least one other overseas market outside your home market for diversification purposes. Personally, the US market is my top pick because it's the world's largest economy as measured by GDP, and it has the world's largest stock exchanges, namely the NYSE, the New York Stock Exchange, and the Nasdaq. In this video, I'll be highlighting a few key differences to consider when investing in the Singapore and US stock markets from the perspective of an investor based in Singapore. The first thing to consider is diversification. Singapore's benchmark index, known as the Straits Times Index or STI, is heavy on financials, real estate, and industrial companies. Just the three local banks, DBS, OCBC, and UOB, make up almost 40% of this index in terms of weightage. That means that any movement in the stock prices of these three banks will also cause a similar movement in the STI. So if you're invested in a diversified portfolio of Singapore stocks, your performance will also likely mirror that of the STI. Singapore also lacks large cap, high growth stocks in the technology and healthcare sectors. There are Singapore companies like AAM, IFAS, and UG Healthcare that have recently garnered a lot of investor attention, causing their stock prices to surge recently. But in my opinion, these companies are still relatively small and may seem a bit speculative to me. On the other hand, the US stock market has many high growth companies in growth sectors like technology and healthcare. US indices like the S&P 500 and the Nasdaq are heavier on technology stocks like Facebook, Amazon, Apple, Google, and Microsoft. These are huge companies dominating their respective industries on a global scale. You can see the huge difference in performance between Singapore and US stocks lately, especially since the pandemic hit. Singapore stocks have underperformed US and global peers by a huge margin. Looking at this chart, the Nikkei AM STI ETF, ticker symbol G3B, had a negative return of 24% over the past 12 months. However, the SPY ETF, which tracks the S&P 500, is up 11%, and the Vanguard Total World ETF, ticker symbol VT, is up 6%. The second thing to consider is the size of the economy as measured by GDP and the stock market liquidity. Singapore's GDP accounts for only 0.4% of the world economy, which is tiny. So even if the overall global economy grows, Singapore may not stand to benefit that much because it makes up such a small percentage of the world economy. In contrast, the US is the world's largest economy and accounts for 24% of world GDP. The US also has the largest and most liquid stock markets in the world. The Nasdaq has an average daily volume of around $250 billion US dollars, compared to just $2.2 billion or around $1.6 billion US dollars on the SGX. The third thing to consider is a big one: taxes. In Singapore, there are no taxes on capital gains or dividends from Singapore-based companies. You can refer to the IRAS website for more information on this. If you're a Singapore resident invested in US stocks, you'll be subject to a dividend withholding tax of 30%. That means that you will only receive 70% of your dividends paid by US companies. For this reason, I've reduced my exposure to dividend-paying stocks in the US and have instead invested in Singapore-based dividend-paying stocks for the dividend part of my portfolio. The fourth thing to consider is the minimum lot size. Investors can buy just one share in the US compared to a minimum lot size of 100 shares on the SGX. This makes it easier for investors in the US to dollar cost average. For example, Apple's share price is $115 per share, so you would only need $115 to buy one share. In contrast, DBS share price is $20, so you would need at least 2,000 Sing dollars to buy 100 shares or one lot. So, US stocks offer a lower barrier of entry, especially for smaller investors like myself. The fifth thing to consider is whether your shares will be held in a CDP or custodian account. As a Singapore investor, my Singapore shares can be held in my Central Depository or CDP account under my own name. Since it's held under my name, my Singapore shares can be traded using any local brokerage. For me personally, I trade my Singapore shares through DBS Vickers. However, US shares have to be held on your behalf in a custodian account. So shares are not held in your name, but rather are held on your behalf in a custodian bank or a custodian brokerage. One downside is that you bear the risk of a custodian bank or brokerage going bankrupt, although this is pretty unlikely in Singapore because of strict regulations. Personally, I trade my US stocks with Standard Chartered and more recently with Saxo Markets as well. Another thing to consider is foreign exchange or FX exposure. Since US stocks are denominated in US dollar, you are exposed to FX risk. If US dollar declines against the Sing dollar, your investments will similarly lose value in Sing dollar terms. Usually, FX effects may not be large, but they are not insignificant either. For example, since the US dollar to Sing dollar peak of 1.45 back in March 2020, the US dollar has declined versus the Sing dollar by around 6% to 1.36. The last thing to consider is familiarity of local companies and their brands. Since Singapore-based companies operate within our local market, it is easier for us as investors to keep up to date with the latest company developments and maybe even experience their services firsthand. Although this may be more of an intangible consideration, it is still important for us to understand the underlying business instead of viewing the stock as just a number or a chart. The good thing about being in Singapore is that we have the benefit of having many American businesses operating in Singapore. So being able to use the products and services offered by these companies, I feel that I am in a better position to understand how the company works and what the company is able to offer its customers to a certain extent. So in conclusion, dividend investors based in Singapore might prefer investing in Singapore stocks for their regular and stable dividends, instead of US stocks subject to the 30% dividend withholding tax. This 30% might not sound like a lot, but it takes off quite a big chunk of your dividends in the long run. However, being fully invested in just Singapore stocks means that we risk continued underperformance versus global indices. Of course, historical performance is not a prediction of future returns, but it's important for us to be aware of this risk. Also, dividends are not the only source of returns, and we should also consider the potential for capital growth. Investors focused on growth might prefer to invest in US stocks instead because of the many startups and high growth companies listed there. Ultimately, I feel that both US and Singapore stocks can offer something for investors. Personally, I diversify my stocks pretty evenly between the US and Singapore stock markets. For Singapore stocks, I focus on mature, well-established companies offering a stable dividend, maybe with some potential for capital growth. For US stocks, I focus on growth stocks with the potential for long-term price appreciation, regardless of whether it pays a dividend or not. Also on a side note, I prefer to invest in US listed ETFs instead of Singapore listed ones, mainly due to the breadth of ETF choices there and the good liquidity in those markets. So that's all from me today. If you found value in this video, please drop it a like and share it with your friends. Subscribe to my channel if you would like to get more content like this, where I share on Singapore and US stocks. And drop me a comment below on whether you invest in US or Singapore stocks or both. And thank you for watching, and I'll see you in the next video. Bye.